And it's 1:30 p.m. right here in Lagos, Nigeria. Coming up on the program, East Africa's biggest economy is under pressure to review the pricing of close to $51 billion of foreign debts denominated in U.S. dollars. And Fitch Ratings expects Ghana CEDI to end 2023 at 12.40 CEDI to $1, appreciation rate for lower than the 38% recorded last year. The Central Bank of Nigeria gives an update on the RT200 policy. Hello and welcome to the program. I'm Ladi Williams. First off, let's take a look at how the markets are performing, starting on the African continent. It's negative sentiment right here with the NGX down about 0.04% at intraday at 52,557 points. And we see the South Africa index, that's down 0.96%, almost 1%. On the flip side, EGX, that's up 0.61%. And we see Kenya closing positive over 0.5%. That was yesterday. Let's take a look at the Middle East now. We see it's also negative sentiments there. In UAE, Abu Dhabi and Dubai index both down 0.12% and 0.14%. Other markets we track in the Middle East, you see just Saudi Arabia there in the green, up 0.49%, while Qatari index 10,693 points, down 0.21%. Let's move on to Europe now. Now the pandemic is over, tourism is back, and Europe is heading towards the summer travel season. Let's talk to Lars Holter right there in Berlin. Great to have you, Lars. So after some rough times, what's the current outlook for tourism in Europe?
Yeah, thanks for having me. The outlook for summer is fantastic. If you just ask anyone in the tourism industry, it seems that Germans and others in Europe too, for that matter, are doing their best to recoup what they've been missing out on during the pandemic. There was a time, of course, when travel wasn't possible, and despite all sorts of economic problems that could bother people right now, there's nothing stopping them from traveling. The CEO of TUI, that's the world's largest tourism provider, and they're headquartered in Germany, he says that bookings right now are so strong, in fact, that there likely won't be any cheap last-minute deals this year, because pretty much every destination will be fully booked. And another bargain won't be available any longer, the super low-cost flight. The CEO of TUI says the times of ultra-cheap flights are over. That means no more 30 euro trips to the Mediterranean islands. Those were a big deal in the past, but they were also, of course, extremely controversial.
And how are airlines faring in the current environment?
Well, airlines seem to be pretty upbeat too. Just look at news from Ryanair. The Irish airline is Europe's largest budget carrier, and maybe they're benefiting the most from the end of ultra-cheap rates. You see, those ridiculously cheap flights were good to increase flight volume, of course. People started taking not one, but maybe 5 trips a year to their favorite islands, but at a rate that left no profit margin to the airlines. Now, with stronger prices in the industry, Ryanair is so optimistic about its business and growth prospects that it has ordered over 100 new 737 jets from Boeing. The deal's been in the making for a while, but it had stalled over a pricing dispute, and now apparently the parties have agreed.
All right, interesting trend there, but who's benefiting more from the current trends?
Well, looking at destinations in Europe, it seems that Spain, Greece, and Turkey are the top choices for travelers. Egypt, the Canary Islands, and Thailand are also high up on the list. For some of them, tourism is a big part of the economy and adds significantly to the country's gross domestic product. Looking at other trends, and that's certainly interesting for investors, cruises are back. They've been often criticized for being a particularly wasteful sort of travel, with cruise ships, of course, having high emissions and all sorts of problems that actually go against many perceived trends towards a more climate-friendly tourism. But it turns out climate-conscious travel is really just a small niche of the market. It's attractive to only 6 to 8% of customers. Cruises, on the other hand, are booming, and that's mostly because they offer all-inclusive deals that make it easy for travelers to budget. So these cruise lines should be among the big winners this summer season, and that's why we can also see that in the market, some of those shares have already gained value in the past months.
All right, we'll keep tracking that industry as the summer approaches. Thank you so much. This is Lars Horta right there in Berlin. Thank you. All right, let's take it on to the UK now. We have Juliana standing by right there, and it's still about rates right now, with central bankers globally still trying to rein in inflation. Great to have you, Juliana. So Goldman Sachs says the Bank of England may have to raise rates to about 5% this summer.
Yeah, that's absolutely right. Good afternoon, Laddie. The US Investment Bank has been weighing in on UK economics as the UK wait for Thursday, which is MPC Day. They will be meeting on Thursday at Threadneedle Street to decide on interest rates and whether we go north or south. I think pretty much everyone will agree with what the lead economist was saying at Goldman Sachs, and that is we are expecting for the 12th successive time interest rates to be hiked in this country yet again. It's currently sitting at about 4.25%, thinking about a quarter of a point rise. That will take us to 4.5%. And if you consider the fact that double-digit inflation remains stubbornly imprinted on our output, it does appear as if we can expect more interest rate rises for the foreseeable. Of course, this has a negative impact because it basically means that it costs more to borrow. And it's not just mortgage owners, millions of them who are struggling with higher interest rates on their mortgage payments, anyone who's got a significant loan in the UK. So this also includes car loans and personal loans. They are going to be feeling the full weight of that. Also as well, high interest rates does have a political story, because at the beginning of the year, when the Prime Minister Rishi Sunak was setting out his 5 promises, one of them was halving inflation. We're nearly 6 months into the year. We're not seeing that any time soon. Inflation is currently at 10.1%, far higher than any other comparable economy, particularly those in the G7. So quite worrying, actually, especially at a time when we know we're going through the worst cost of living crisis that this country has seen in 40 years.
And talking about the cost of living crisis, we see Sainsbury's have cut the price of some lines of bread and butter. Maybe a ray of hope for the cost of living crisis.
Let me tell you, that is a ray of hope, because if you haven't got any food at home, some bread and butter, Laddie, I don't know if you've been through those stages of your life before, but bread and butter and whatever's in the cupboard in a tin is good enough. And, you know, jokes aside, for some people, that really is what they're surviving on, bread and butter and some tomato soup. But yeah, quite decent news from Sainsbury's this morning. Sainsbury's, of course, being the second largest grocer in this country after Tesco. They said that they are going to be reducing the cost of bread, so Sainsbury's own bread, by 11 pence. I think you can get a loaf of bread now for about 75p, and as well as butter. Butter, I believe, is going to be reduced across different brands by about 9p. Doesn't sound like much, but I think it does show that grocery bosses in this country are committed to making sure the price reductions are being shifted to customers as soon as they are starting to hear that some of the basic ingredients are falling. Of course, we know that wheat was a significant export from Ukraine before the onslaught of the war. And since that time, we are starting to see that wheat prices are slowly going back to their original price, which is why supermarkets are able to pass that down. Similarly, with dairy, we are starting to see that dairy is reducing as well. Having said that, we know that there's a price war going on. According to Kantar, which is a data marketing analytics firm in the UK, some of the European lower scale supermarkets like Lidl and Aldi, they are increasing their market share. We are starting to see more and more people say, do you know what, I'm giving up on Tesco, I'm giving up on Asda, Sainsbury's, Morrison's, the big four, and going to places like that. So I think Sainsbury's are being very, very strategic by price, passing on those deductions as soon as they're able to do so.
All right, let's hope the prices of those commodities keep trending downward to help us rein in inflation at this time. But U.S. inflation data for April, that's due sometime tomorrow. How are the markets in UK bracing for this?
Well, it's a hot ticket. Of course, everybody looks at the data that comes out of the world's largest economy. As I don't know, some people say it's China at the moment, but the West say it's still America. Inflation quite high, but not as high as the UK, of course. In fact, I believe last month, CPI in America only creeped up 0.1% after a creeping of 0.4% in February. Is it going to go any higher than that? The US stock market, which is going to open any minute now, is expected to open much lower because of the anticipation from the Fed's move on interest rates, depending on what we get from CPI. And that's definitely fallen into the UK blue chip index, which at intraday is in the red. The all share is down 0.35%. FTSE 100 is down 2, Laddie, by 0.34%. And the FTSE 250, the domestic market, that's down by 0.54%. In the currencies market, the British pound is currently trading up against the US dollar by 0.09%, up to against the euro by 0.20%. But at intraday, the British pound is trading down against the Japanese yen by 0.03%, Laddie.
All right, Julia, thank you so much. We're looking out for those that inflation data for April tomorrow. Thank you.
Yeah.
All right, now let's see what's happening in Asia now. See Hong Kong's Hang Seng Index tumbled about 2%, leading losses in the region as investors further digested China's trade data that included a decline in imports of 1.4% and a slow growth in exports about 8.5%, with Hong Kong listed healthcare and basic material stocks leading the decline as Asia Pacific markets traded quite mixed there. See behind me, it's Nikkei there. That's up 1.01%. That's the only green we have on the board at this time. ASX 200, 0.17% down. As close we see there. Kospi, that's down 0.13%. So we see those markets in Asia Pacific still hammered at this time. Let's move on to the US now. We see stock futures still under pressure with regional bank shares retreating as investors are ready for that key inflation report that's due out tomorrow. See right there, just as Juliana mentioned, the stock futures already pointing us in the red direction there, 0.34% for the Dow Jones Industrial Average, S&P 500, 4,137 points, down 0.36%, while the tech-heavy NASDAQ, that's also down 0.39%. Looking now, see how the markets actually close at the end of trade today. That's in the U.S. Let's take a look at all markets. Now we'll see all prices down today, relinquishing some of the strong gains of the previous sessions, with market cautious ahead of that U.S. CPI data coming out tomorrow. We see Brent there, that's down about 61 cents to $76.40 per barrel, while U.S. WTI 58 cents. That's also down about $72.58, down 58 cents this morning. Both contracts settled up more than 2% in the previous trading session. Definitely watching out for how those markets play out. And to the metals market now, see gold prices that edged up today with focus on the U.S. inflation readings for hints on future U.S. Federal Reserve rate strategy as economic uncertainties prevail. We see spot gold, that's up 0.5%, $2,031 per ounce, while U.S. gold futures that added 0.3% to $2,039 per ounce. Traders are currently pricing in an 88% chance of the U.S. Central Bank holding rates in June. The Fed Chair Jerome Powell said last week that policy decisions will be data-driven, while also hinting at a likely pause in this cycle. Well, still ahead on Business Incorporated, commodities market update is next. Do stay with us. All right, let's look at the livestock market right here in Nigeria. Now, see the past year, the price per cow leg has jumped by approximately 33% to 4,000 naira a piece, while the price of beef has increased by 14% to 1,600 naira per kilogram. Let's talk to Halima Adediran, our analyst, financial derivatives company. Great to have you, Halima. So tell me, what's responsible for this astronomical increase in the price of cow leg? That's a big staple right here. And is this price hike temporary, or will it be sustained for a longer period?
Well, thank you. We all know that cow leg is an important part of cow itself. And there are some other factors that has been driven the price of cow. But there are some peculiar factors that are affecting the price of cow leg, which is one, the price elasticity of demand for cow leg. Cow leg has an inelastic price. It has price inelastic. The demand for cow leg is price inelastic, which means that there is no kind of change in its demand whenever we have a change in its price. And aside that, cow leg does not have a close substitute, which consumers can shift to and consume when the price of cow leg increases. So those are the major factors that is causing the astronomical increase in the price of cow leg. And aside that, the cattle rearing sector itself has various challenges like high cost of transportation, multiple levies, insecurity, which led to a ban on cattle rearing in some parts of the southwestern and southeastern part of Nigeria, and also the exchange rates because of the supply gap that we have in the cattle rearing industry. At times, we have to import some cattle from neighboring countries like Chad, Niger into Nigeria to fill in the supply gap. So all those factors too are featuring into the price of cow and in turn affecting the price of cow leg. But because it has its peculiarity of price inelasticity and no close substitutes, that's why we are seeing a surge that is higher than what we see in the price of beef generally.
And talking about being price inelastic, where do you see demand going forward?
Basically, for now, we can see that the demand will still be high because of high preference and high taste for cow leg by the consumers. So for now, in the short run, it will still be high.
And another business in that value chain, that's bone crushing. And we see the top exporters here, India, Pakistan, and Nepal. What can we do to position, in that value chain to get more of those exports out there?
Nigeria has a lot to harness in that value chain because we are the sixth African country with the highest population of cattle. And aside that, bone crushing has another aspect, which is the export of raw bone, and it is widely demanded globally. So, but Nigeria has not been able to tap into that opportunity because of one, less awareness in that value chain, and another thing is infrastructure investment. Because for us to export, let's say, raw bone, we need cold chain, and cold chain will be able to make the fat content in the raw bone to be preserved till it is exported. And as well, the demand for the crushed bone too is used in the pharmaceutical sector. It is used as manure and it is used as animal feed. So Nigeria needs to be more aware of the value chain and as well increase their investment in the infrastructure that will be able to generate more export earnings for us in the nearest future.
What kind of policies do you think the government should be looking at, going forward to actually harness this industry?
Number one policy is investment policy, which is very important in any sectoral development. And after that, there will be a need for more education and awareness on the kind of continent and the uses of crushed bone and where and when it is most needed and most required globally. So the government will need to increase their awareness, their education, information generally, then now invest in the value chain.
All right, so much to do there. Thank you so much, Halima, data analyst, financial directors company. Thank you.
Welcome.
All right, let's take a look at some stories now on the African continent. We see East Africa's biggest economies are under pressure to review and renegotiate the pricing of close to $51 billion of foreign debts denominated in the volatile US dollar as use of international pricing benchmark. This LIBOR rate officially comes to an end on June 30th. Financial institutions and companies are also under pressure to shift their commercial contracts pegged to the London interbank offered rate as LIBOR to alternative benchmarks ahead of the deadline. Kenya, Tanzania, and Uganda hold over $51 million in foreign debts denominated in US dollar, with the strengthening of the greenback adversely impacting economies' mounting debt burden. And the Ghana cedi is expected to end 2023 at 12 cedis 40 to $1 US, meaning the rate of depreciation will be far lower than the 38% recorded last year. According to Fitch Solutions, the argument is based on the premise that Ghana will secure an International Monetary Fund support program by May, which is this month, 2023, that will go a long way to cushion the cedi against foreign exchange pressures. And the RT200 export program, which the CBN sees as a critical tool for attaining sustainable and stable external balance and safeguarding the value of Naira, has brought in $1.7 billion as in the first quarter of this year. The governor of Central Bank of Nigeria, Mr. Godwin Emefiele, revealed this at the third RT200 summit held in Lagos, Southwest Nigeria. Mr. Emefiele is asking more exporters to embrace the program, as he's promising that the CBN is working with deposit banks to make the process more accessible to all. Take a listen.
Unfolding global economic development suggests that monetary policy was reaching its limit and would need complementary help from other spheres of the economy to propel for sustainable advancement. Our Naira for Dollar and RT200 initiatives are all attempts in that direction to drive long-run economic development. In the first quarter of 2023, a total of $1.7 billion was repatriated to the economy, while about $970 million was sold into the INA window year to date. The balance of the proceeds remained in the export domiciliary account of our exporters. And please note that proceeds that are not sold at the INA window cannot and will not be eligible for our rebate. I want to assure you that the bank is committed to strengthening and expanding foreign exchange supply into the market. Naturally, you are all important in this clarion call of expanding the supply of foreign exchange inflows into our economy. For exporters flying the flag of Nigeria in the international market, the Bankers Committee and the CBN stands ready to partner with you to achieve your goals.
As the Central Bank governor there giving us the details and an update for the RT200 policy. All right, that's the show today. Thank you so much for watching. Join us again, same time tomorrow. I'm Ladi Williams. Bye for now.